If you are an option seller and sell a lot of naked positions, one bad trade can really damage your account. But when we hedge it like this, which you know from this technique, it costs quite low. Hi everybody, welcome to the video. If you are an option seller and if you do a lot of naked selling, in this video you're gonna get a really good idea in terms of hedging. The hedge every option seller must know. Before I start the video, I have to tell you standard disclaimer, strategy, the methods, the hedging techniques which are going to be explained in the video contains certain degree of risk. There is no method or strategy which is 100% foolproof. Please keep a note of it. Knowledge which helps you become a better trader, and this is exactly what we are going to talk about without wasting any time at all. How option selling looks like and what we are trying to fix. Let me show you exactly how majority of the people sell options, and there is a blind spot in that which we'll try to cover today. Let me show you that. Let's go to simulator and learn everything. So here we are on a simulator and I've selected a monthly series which is of December. Now when there are busy people who are trading the markets, what they look forward to do is that they look forward to sell far out of the money call and far out of the money put. The most popular strategy ever for theta DK traders is the short strangle. Let me show you exactly how the short strangle looks like, although all of you I'm sure must be already familiar how it looks like. So we go here. So we are going really further out and we are selling a call option, right? And this is just a simulation, right? I'm not telling you to sell this particular Greek or an option. And then the same thing we're going to do is we go far out put side and we select a strike and we sell this strike. And when we do this, something very familiar will jump out on the screen for you, and which looks something like this, as you can see over here, right? What you see is a very big range selling an option, call and the put, and especially busy people. Also, one more very important thing is that the estimated margin is approximately 1,45,000 as per the simulator. If market stays in the range, then we can expect obviously the maximum you could see over here. But things start to change very fast in options, right? This is a very dangerous strategy too, because if market really go very fast in one direction, or there is any kind of a black swan event which comes, any kind of a big huge gap down which happens in the market, then the trade very fast can come very deadly. This is a very high risk strategy, but this is very popular among a retail trader because to our eyes, this looks pretty good, pretty big and wide range. Now, there are many people who've been doing it for many months, and today I want to address it. Is there any way by which we can hedge it in? What can we do? Now, a lot of people will say that, probably what we can do is we can buy a 28,200 call or probably 23,300, one call above and one put below. If you buy it, then it's gonna become a normal iron condor. And you're not watching this video to learn iron condor from me, right? You want to get a better hedging technique. So here I have a question for you. This is a monthly series because November is already half gone now, right? So I've taken the series which is roughly 40-45 days out. Anyways, that's not a point. The point which I'm trying to make is how to hedge it. Now what we're gonna do is we look forward to buy the call, but we are not look forward to buy the call which is December. December is around 40-45 days out if we do this strategy, right? What we can do is instead of a monthly option, we straight away jump into the weekly option, right? Remember, we have sold 28,000 call, this one, right? 28,000. Now 28,000 call is not available on the weekly option, right? So maybe it will be available for very economical. We can look forward to long call which is trading around 1.3 premium, because it's really far, so premium is hardly there. Now obviously we are buying the call, and now the next step, if you've guessed it right, we look forward to long the put as well now. So we go down and we go really further down and we spot a premium which is trading at 2 points. And what if we buy the call and the put as well, but at the same time you're uncomfortable with selling a naked option. Or if you use a lot of capital and you want some kind of ways how to decrease your margins. Now when we do this, what you see is that obviously the payoff is looking very different. Now I've told in many of my videos that payoff is not 100% to be believed or taken on the face value, because things change very fast in the payoff, as you see. And here what do we see is that we have bought. The overall position is that the sell options remain the same. The buy option is that we are buying at 1.3 or 2 approximately. And what do you see? The impact which is buying the hedges have on the overall margin, that the overall margin have become around 80,000. When we do something like this, one thing which really must strike you, that is, if any kind of a big huge gap up happens, then 27,000 call will come first and then 28,000 call, which we sold. So it's already inside 1,000 points. On the put side, I've sold approximately the same premium. I can obviously sell maybe a 24,000 put, which is 500 points inside. So the safety buffer improves by just paying slightly more extra premium. Very important point is that this 1 or 2 rupee option can lose probably 50% of the value. Suppose if I try to trade it today and if I hold it, not a recommendation, but just to tell you the hedging, how it works is that if I try to trade it today and I take my trade to the next day and I do not square off, obviously there's going to be some theta impact. These calls and put are expected to decay, but how expensive call or put have I bought in the first place? Just 1 or 2 rupee premium, right? 2 points premium, which comes out to be like how much? 75 multiplied by 2, it becomes 150. So does this solve my purpose or not of hedging? Now, one more thing I must tell you in this before I tell you the common mistakes which maximum people do. That is that this kind of hedging does not cover your full risk. So if there is any kind of a big, huge gap down, this much of an option which we bought, it's not there to cover the entire storm of the negative MTM, but it can work as a shield. It can work as a protector in if there is any kind of a huge and big gap down or a black swan event. It's always wiser to have some kind of a hedging in your trade than just simply selling naked call and naked put option. But any kind of a big huge gap down can really dent the trading account. Now, having said that, what are the other things which I must tell you? That is hedging, impact and margin and risk profile. I've told you a bit about that as well. Now, common mistakes. Is this the end of it? I'm sure you would like to watch the video till the very end. And if you are a trader who would like to know about other different strategy, probably your favorite strategy, your common strategies which maximum retail people do, maximum people who watch this video, but they want to learn different kind of adjustments. All you got to do on this channel, on the search, you could just search probably if you trade Iron Condor, just type Iron Condor and then the Iron Condor videos will show, or Iron Fly or Straddle or Batman or any of that. Warning and mindset, it won't make you risk free. Important point to know, right? So that you keep your position size according to your risk. And don't be greedy. Use part of your credit for protection every week. I want to make this point a little clear to you. So what do I mean is that the net credit which we have is 19 plus 24.35, right? This is the net credit versus what we are buying is something which is like approximately 1.3 or 2 approximately. Right? So do not look forward to target the entire premium. It's always wiser and better to probably, give some part of it as a hedging protection. And then if market open the next day on the same very price, we expect to have some kind of a theta decay from our main sold expensive options. That is something good because you are just buying extra hedging from the credit which you received already. That is the exact reason why I tell you hit and trial way of trading one must completely avoid just by buying the options, the call and the put option in weeklies can really help us with any kind of a big black swan events. You do not need to square off if you like to keep it. If you are trading with the lesser margin, tweak your weekly options. that is expected to give you some kind of an extra cushion. I'm sure you must have enjoyed the video, and if you do a lot of option selling, and if you do non-directional option selling, and if you've been doing option selling, the strangle from a long time, you must have got a really good idea today. And that's how it's supposed to be. It's always better, smarter to learn from somebody else who's probably more experienced, somebody else who's got better strategies, better techniques. It's all about improving on your trading and reaching to the next level really quick. Thanks for watching, and I wish you all the very best. Take care. Signing off. Bye-bye.